Okay, friends, so the Feds do it again, bumped up interest rates another 0.25%, but we saw mortgage interest rates come back down just a little bit. So why is that? Well, as a reminder, mortgage interest rates are not directly tied to the Fed rate hikes. What they are tied to is the level of inflation. The Federal Reserve is directly raising short-term interest rates, which is different than the yield on the 10-year Treasury. The cumulative impact on the Fed rate hikes is starting to have the intended effect, which is to bring down inflation. So rewinding back since March of 2022, we've seen 9 rate hikes starting at 0.25% up to 0.5%. The Fed's got aggressive at 0.75%, and then now since December, they're scaling back to where the impact or the increase has gone from 0.5% now with yesterday's hike only 0.25%, and we may have seen the conclusion of the long history of rate hikes over the past year. Now, as we start seeing inflation finally trickle down, we're going to see rates follow back down along with it. The big question is, how is this going to impact the housing market once we start seeing rates come back down? We know we are already short on inventory, and if more qualified buyers come into the market after a rate drop, we're going to see competition spike again. So if you're a buyer right now trying to navigate this market, trying to decide is it better now or to wait, well, if you're willing and are able to buy right now, you're going to be able to negotiate the best terms in this market before we see a shift back to a seller's market. If we're back into a seller's market, there's going to be more buyers that you're going to have to compete with and much more difficult to negotiate the terms that may be what's best for you. So, in my advice, go ahead and buy now. We'll put together a refinance for you when the rates drop.